Good morning. I'm Tim Nyland, and today we are reintroducing the Earnings Certain Dividend Aristocrat 25 stock core portfolio for 2021. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. Today's webinar is the fourth webinar in the new 2021 ECP family series. I have all three of the prior webinars circled in red on the screen. We started out 3 weeks ago, roughly, with the Earnings Certain family of equity model portfolios, how it all got started. Talked about the constructs and how it was actually designed and developed. And then we moved on to the Earnings Certain Core 75 stock portfolio. This is the portfolio where everything is more or less derived from. And last week we discussed the Earnings Certain Core Admiral 30, and today we're going to wrap up the actual family itself with the Dividend Aristocrats portfolio. If you'd like to do the kind of analysis you're going to see in this video, then you're going to need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Today, I'll be using Zacks Advisor Tools to showcase some new sector allocation reporting capabilities and the research system with composites to look at the variability, valuations, and profitability trends of both the Dividend Aristocrat portfolio on the Earnings Certain side, as well as the S&P Dividend Aristocrats, traditionally known as NOBL, the ETF NOBL. So let's go ahead and get started. 6 key points I'd like to review and emphasize a couple things. Again, this is the 25 stock subset of the Earnings Certain Core 75 portfolio that contains most of your higher yielding and lower growth names. Now, that's obviously relatively speaking, since the Earnings Certain 75 portfolio tends to be high growth anyway. So keep that in mind as we're going through this. Recall as well that all of these companies provide goods and services that are used by everyone every single day, whether you know it or not. In core, again, we don't hold financials, energies, real estate, utilities, commodities, precious metals, and other economically sensitive names. We do this with tilts. They are not present in core. So none of these sectors or industries are present in the ECP 75 stock portfolio, so they will not be present in the Dividend Aristocrat 25 stock portfolio. Also keep in mind that Apple, Facebook, Microsoft, Netflix, Amazon, Google, any of the latest IPOs, there's very strict criteria for being included as an Earnings Certain member, and length of history of financials is one of them. And so there are definitely no IPOs, no pot stocks, or any other flavors of the day. We can tilt in with those names if we choose to do so, but they're not present in core. Most important addition for this week in the 6 key points is that neither the Dividend Aristocrat 25 that we're going to speak of on the Earnings Certain side, as well as the S&P 500 Dividend Aristocrat, typically referred to as NOBL, is going to outperform the S&P 500 long term. So we're going to spend some time on this today and discuss how we manage this. So the key to remember here is that we manage this with those long-term macro tilts and the shorter-term tactical tilts, and that's going to give us that beta exposure and resulting upside capture. So again, the idea here is to keep it easy. It's a very easy strategy to follow, one that your clients will surely appreciate and be comfortable and will understand. And this is definitely a strategy you can call your own. So let's review again the S&P 500 out of the research system. This is the composite of the S&P 500, high volatility, low earnings stability. You can see that with the orange trend line here in earnings, the EPS stability, obviously very cyclical, and then that high volatility with the blue line in price. You can see that price just getting dragged through those recessionary troughs. And obviously, that's something that we strive to avoid with the Earnings Certain family. The S&P 500 has low annual EPS growth over 25 years, relatively speaking. You can see that this compounds out on a least squares trend basis to about 7% over 25 years if you do a least squares fit to that earnings line. And this is basically comparable to the S&P 500 Dividend Aristocrats. In other words, if you were to put the Dividend Aristocrats up on the screen, such as I have here, you will see that it's almost a mirror image of the S&P 500. A little bit, obviously, a little bit lower growth, but same volatility. So high volatility, low EPS stability, same as we saw with the S&P 500. And if we snap a least squares fit to growth of that EPS line, you will see that that's about a 7.2% least squares growth for the S&P 500 Dividend Aristocrats ETF. A little bit different when we start talking about the earnings certain Dividend Aristocrat Core 25 stock portfolio. Again, as we would expect, this is a very, very low volatility strategy. So you can see here that that protection that we have in protecting that earnings line through recession gives us that extra protection for downside price activity during recession. So high EPS stability, we can see how straight this orange trailing 4-quarter operating earnings line is relative to the price series. So very, very low volatility, very, very high EPS stability underlying for those 25 names. Keep in mind too, pay attention that we're trading off some growth for that stability in earnings here. So you can see 8%, 5%, 4% for the ECP Dividend Aristocrat strategy. If we back up a couple slides, you'll see that we've got 21%, 5%, and 6% for NOBL. And keep in mind here that a lot of this is due to the reopening phenomenon, and those returns are ultimately going to normalize out to this long-term least squares trend rate. The other day we spoke last week of the S&P 500 growth, and it was roughly 34. I think this was 12% last week. It's actually been revised down to 11% now and 11% for 2023. So almost flat for 2023 now. So what we're going to do now is we're just going to kind of wrap up some of these summary characteristics. So I've got the entire family up here relative to both the S&P 500 Dividend Aristocrats and the S&P 500. And so we can see the volatility, right? We got high volatility for the S&P 500. I put down here medium volatility for NOBL only because we've traded off a little bit of perhaps the growth for maybe some stability, just because it has a little bit higher dividend yield. So both very volatile, and obviously the lowest volatility is going to be in that ECP Dividend Aristocrat 25 portfolio. And you can see that beta of 0.67 offering us quite a bit of protection there on the downside. So EPS or ECP Core 75, low volatility with a beta of 0.1. The Admiral 30, almost just as low as the Dividend Aristocrat 25 at 0.68. Remember, we pay attention to the beta. That's something that we're going to have to manage, obviously, to participate in the upside capture. So keep in mind that beta. Obviously, S&P has a beta of 1, and NOBL actually has a beta of 0.91. We'll talk a little bit more about that here in just a minute. We take a look at yields, right? So we'll use S&P 500 as kind of our baseline. When you compare yields across the board to the remainder of the ECP family versus NOBL, obviously NOBL is going to have the highest yield. And then you've got your core 25 Dividend Aristocrats with the next highest yield. And then we go down to the lowest, which is the ECP Core 75, and then the Admiral 30 with low yield. And it's really just a trade-off between your annualized EPS growth and your yield. So those that have the highest rates of growth are obviously going to have the lowest yield. Those with lower rates of growth are going to have higher yields. So that's pretty much the balance. EPS growth rates, again, keep in mind that we've got the annual EPS growth rates we looked at. This is a 25-year least squares trend, okay, for each of these. And what you're going to want to note is the FY1, FY2, FY3 trend. Ultimately, that growth rate long-term will end up reverting to that 25-year trend. So you just want to kind of pay attention to the reopening phenomenon that's taking place with both of the S&P names versus the rock-solid stability that you get with the ECP names. And that's speaking again to the difference in that volatility. Keep in mind, take those FY3 numbers with a grain of salt, especially on the Dividend Aristocrat 25. I would expect this to get revised up in the near term because these growth rates are going to revert back to these 25-year trends ultimately. So let's go ahead and take a look at some of the portfolio risk metrics for the ECP Dividend Aristocrat 25 stock portfolio. And we're going to do this with no tilt. And I'm doing this relative to the S&P 500 as a benchmark for a reason. Even though I stated in the very beginning, one of the 6 points, I had it highlighted in bold, that the ECP Dividend Aristocrat and the S&P Dividend Aristocrats, both of those portfolios are not going to outperform the S&P 500 long term. It makes sense because this is more of a yield strategy, more of an income strategy. But what we have to do is we have to make sure that we are protected on the downside, and we make sure that our returns per unit of risk are in fact adequate. And the other difference here between this portfolio risk metrics discussion that we're having this week versus ones that we've had in prior weeks for the remainder of the ECP family is that we're only looking at 7-year performance here through April 2021. So there's only 84 months instead of the 100 and I believe it was 120 or even more, maybe 180 that we were looking at in the last several weeks. The reason for that obviously is NOBL was started, I believe, roughly in October of 2013. So we could only go back to 2014 to do this, the beginning of 2014 to do this analysis. So that's the reason for the shorter time frame. But what I want everyone to take away from these risk metrics, we're going to do a side-by-side bake-off here in just a minute. I want everybody to just focus for a minute on what's in red, because that's really what we're managing to when we talk about the Dividend Aristocrat strategy, both on the ECP side as well as the S&P side. And you'll see that the portfolio itself struggles with all market performance. That's including up markets and down markets, right? So for the 84 months in the observations here, we had 60 up markets, we had 24 down markets. I want you to see that those 60 up markets, the excess return was substantially negative, and the down market was substantially positive, right? All market returns clocking in at about 2.56% per year. We lag the S&P 500. Notice that the win rates here too for all market, up market, I like to color code anything less than a 50% in red. So you can see down market, we actually had 17 months of outperforming periods, which was a 71% win rate, which is actually pretty solid. So it doesn't look much better when we look at NOBL. And what I want everybody to see here is, again, negative excess returns, struggles in the up market. The down market here, obviously much less. The idea is the difference, if we scroll back here to the previous slide, is that the down market protection for the ECP Dividend Aristocrats is light years better than you're getting with NOBL. And what I want everybody to look at here is the beta of 0.67 relative to that R squared of 0.68. And the Sharpe ratio of 102. When we go to the next slide, you'll see that these numbers are very different. So we'll move on to a side-by-side bake-off, and I've got a lot of this highlighted here. So that the highlights in blue are basically what we're managing to, and that's the 0.67 beta for the ECP Dividend Aristocrats, which gives us this phenomenal downside outperformance in down markets, versus the beta of 0.91 and the R squared actually of 0.89. So we've got a lot better diversification relative to the S&P 500 with a lower R squared of 0.68 than you would if you were using the NOBL portfolio of 0.89. And basically the 0.68 is basically telling us what percentage of the returns can be explained by the underlying movement in the benchmark. And so the lower this number, the better the diversification your portfolio has to offer you. So that's a really, really good strong suit to the ECP Dividend Aristocrat portfolio. Also notice here too, the Sharpe ratio slightly better for ECP Dividend Aristocrats. Everything here in green is going to be better than NOBL. And you can see that it's not much different than the S&P 500 over this observation period, but it's at least it's not negative like it is for NOBL. So the idea here is that it's return per unit of risk, right? So you're getting a little bit better returns here for the ECP Dividend Aristocrat for every unit of risk that you're taking on. And we use standard deviation, obviously, as that unit of risk measurement. Your value at risk, obviously much lower. Max drawdown is literally half of NOBL, and we saw this, right? We saw this last year during the COVID downturn. The ECP Dividend Aristocrat portfolio was just absolutely crushing NOBL. And you can see that here. So annual turnover is roughly 4% for the ECP Dividend Aristocrat portfolio. And I have here unknown. It's just because we're actually using the ETF itself to actually run the performance here. So we just don't know the turnover of that ETF, but I'm assuming it's fairly large. So here's where we stand. The 12.59, obviously far superior, and we manage to these excess returns in the all market and up market that are negative. And we have to do that for both the ECP Dividend Aristocrat portfolio and NOBL. There's no perfect answer here. The nice thing is with the ECP Dividend Aristocrat is that you're very well covered on the downside. So the upmarket returns you can address with adding additional beta, and that'll obviously take care of the all market annual return as well. Then you can do the same thing here with NOBL if you choose to use that. However, you're just not getting that downside protection. So the idea is, again, why does this work, right? We've been through a lot of these slides in the past several weeks. I'm going to hit you with just a couple more, and then I promise we're done. I love to look at the price and earnings charts for just representative names in NOBL. Obviously, names that we would never own in core, ExxonMobil. Everybody's raving about the returns year to date for energy. Great, they're having a great run. This has been absolutely a disaster if you've been sitting in ExxonMobil since any time since basically 2005. You've still lost money. The same thing with AT&T, the likes of AT&T, just a huge disappointment. You might be getting a 7% indicated yield, but you're actually giving up principal to get there. So it's more of a return of capital instead of a true dividend there, because you're just losing the value of your investment as time goes by. So what we like to do, obviously, with the ECP Dividend Aristocrat, is the 25 stock portfolios, we love to see that blue line and price just continue to march higher along with earnings. So we don't have those troughs and that variability, and still get a nice yield. And so we get names like Amgen and Procter & Gamble. Note that Procter & Gamble is also present in NOBL, but currently it only has about a 1.5% weight. And keep in mind that we equal dollar weight each of the 25 names in the ECP Dividend Aristocrat. So each of the names actually has a 4% weight. So you've got a much larger weight of Procter & Gamble in the ECP Dividend Aristocrat than you do in NOBL. So just something to make note of. When we start looking at the profitability metrics, this is one of the things that makes the strategy so successful. And again, we don't manage the portfolio to these metrics. This is literally a byproduct of the discipline that's been in place for over 25 years now. So after everything is said and done, and you've gone through all the distillation through the standard industrial portfolio, SIC, CRO, the ECP Core 75, all the way down to the Dividend Aristocrats, and you look at what you have, the end result, this is what you get when you do it properly. The return on assets here, obviously far superior for the earnings certain Dividend Aristocrat portfolio. You could call it a 2x, 2.5x, whatever you want to call it. And it's not just a 1 or 2 quarter or even a 1 or 2 year anomaly. It's literally every year for the last 20 years and beyond. You take a look at a company like Procter & Gamble versus AT&T. Again, I just grabbed stocks at random. AT&T, again, has just been a train wreck. Return on assets for Procter & Gamble since 2016 have just been literally just going straight up. And this is what we like to see in our investments. We grab another one at random here that this time is not in NOBL, which is Amgen. And I grabbed ROE. I grabbed Amgen for ROE. Its ability to compound return on common equity is just spectacular. They've been running a massive share buyback program for years, and it ramped up significantly back in the last couple of years. I think it ran up even as high as 7, 8, 9%. And they were buying back that amount of stock each year. It was huge. But what it was doing was it's actually pushing up your return on equity. So you can see that in the metrics here. So the debt financing was actually a lot cheaper, so they took on a lot more debt. So in the next view, we're going to go to the ROC, and you guys know I love looking at the difference between ROE and ROC as to the change in profitability when you incorporate the total capital structure. And so we'll look at that next. But what I want everybody to focus in up here is this top section. When we look at the earnings certain Dividend Aristocrat portfolio relative to the S&P 500 Dividend Aristocrats, you're literally looking at 3 times more efficient at compounding return on common equity for the average stock in that portfolio. So just a huge difference. And obviously with Amgen versus AT&T, I mean, wow, it's just absolutely shocking. You're looking at like 7.5 times more efficient. And again, a lot of that is due to that share buyback. So if we take out the effect of the common equity of the share buyback, and we actually lump in the long-term debt that it's taken on, it's still a winner. So I want you to see what happens to AT&T's here as well, because they've taken on debt. So AT&T gets cut in half, Amgen gets cut down by roughly 75%, but keep in mind that you're still sitting at 3 times better return on capital for Amgen than you are AT&T, and that trend just continues to be positive here. A little bit of a rollover here since 2020, but all in all, positive. Another one of my favorites, the ability to compound cash flow, return on invested capital. Again, just speaking to the ability to generate cash. Just a huge difference, right? The average company in the earnings certain Dividend Aristocrats portfolio more than 2 times more efficient at generating cash on invested capital. And when you take a look at a company like Procter & Gamble, again, Procter is in NOBL, but our weight is 4% versus NOBL's about a 1.5%. I went back to Old Faithful Exxon here. You all know the story. I mean, Exxon's just been a train wreck. This is an industry that's just in decline, and you can see that here from the free cash. It's literally 1.77% return versus Procter & Gamble sitting at about a 23. So call it what you want. It's a huge beat. When you take a look at the way that these 2 portfolios tend to trade from a valuation perspective, it shouldn't come as a surprise to anyone that the strategy that involves that type of stability and that type of downside protection, that investors would not be willing to pay a little bit of a premium for those names in the earnings certain Dividend Aristocrat portfolio. And you can see that they've been doing that for the last 20 plus years, and even further back if I were to extend this time frame. And so this should definitely not come as a surprise, right? So you can see the blue line always riding higher than the red line, and that definitely speaks to the premium that these companies command for that stability in earnings, the stability in the underlying dividend, cash flows, and everything else. These are just premium companies. So if we take a look at one of the most important metrics in terms of valuation, everyone knows I love to look at the 5-year median of the PEF12M versus the S&P 500 during this time frame. The 5-year is just really, really critical. It's 5, 10, and 15 that I love to look at. And we just jump straight to the 5. We're literally trading in line with its 5-year median relative to the S&P 500. And again, that's PE on an F12M basis. And you can see where that's clocking in right here. So very, very much in line. So if you decide to take on an ECP Dividend Aristocrat 25 stock strategy, you're going to be coming right in line with valuations where they tend to be as a measure of central tendency. So no issues there. When we talk about implementing the ECP Dividend Aristocrat 25 stock strategy as a core equity model, keep in mind that this again is an equal dollar allocation. If you're gonna take on any sort of tactical tilts, then I do recommend doing a quarterly rebalance, because with anything that short term, you just want to make sure that you're rebalancing and taking your profits off the table. If you're only going to stick to the core allocation or even apply some macro long-term tilts, then just rebalance a minimum of 1 time per year is all you need to do with this strategy. So just very, very easy to maintain the strategy. So we're going to go through a couple steps here. It's very, very simple. For 2021, we're just going to use 100% as a baseline weight to get started if you're benchmarking against the S&P 500 Dividend Aristocrats, right? So it's literally just a 1-for-1 replacement. And the reason for that is the technology and communication services sector are already greater than or equal to the weight of the benchmark. So technology is a little bit of an overweight, and there are no communication services stocks in either of the ECP Dividend Aristocrat or the NOBL ETF. So we can start with 100% as baseline. Then what we have to do is we have to decide if we want additional growth, if we want to try to get some of that upside capture, raise that beta, try to maybe compete performance-wise a little bit tighter with the S&P 500, then we're going to want some additional growth by raising that exposure to that tech and communication services sector. The other thing that we'll want to do is apply those tactical short-term tilts. And again, we use the short-term tilts to gain exposure to all of those sectors and industries that aren't in core. Financials, energies, real estate, utilities, commodities, precious metals, any other economics cycle-sensitive names, including any sort of semiconductor names. Those are going to be the most cyclical out of the technology group that traditionally speaking we don't include in any sort of long-term core tilt. So those you apply tactically. So the idea with tactical tilts is you use these to basically get additional exposure to both growth and income. And you can see that I actually have that here in bold for you. And you're more than welcome to request a copy of this slide deck so that you've got it. Just go ahead and shoot us an email at the end. There'll be information where you can reach out to us. And again, in step 2, when we're applying that long-term macro tilt, we're really doing that for growth. So growth is long-term, shorter term, you're tilting in for growth and income. Okay, that's what you got to remember. So let's just go through a couple of hypothetical examples of how you might use this depending upon where we're at in the business cycle. And there's certainly individual cases are going to vary. I mean, this is really, really subjective depending upon growth versus income requirements. So just kind of keep that in mind. And we have a new support service that's available, ECP premium level support that can help walk everyone through this. So at any rate, feel free to inquire on that as well. So when we're preparing for recession, again, there's a lot of indicators out there. The one that I love to use is that 2-year treasury converging into the 10-year, and then they both start heading down into the down cycle. That's when you've literally got 12 to 18 months to really kind of shore up your plan for potentially having a recessionary scare at a minimum or outright full-blown recession. And obviously many causes, but that's basically one of your leading indicators right there. And so at this point, you can go into what I'd like to call the 85% weight, right? So this is where you're in a more defensive stance, right? We've raised that allocation to the Dividend Aristocrat Core 25 stock portfolio all the way up to 85%. But we keep that macro long-term tilt in play at about 15% to just go ahead and continue to benefit from any upside capture that might be there. Also, these macro long-term core tilts tend to fare fairly well going into a recession. So if there is a scare, you'll be a lot better off than you were holding any sort of tactical short-term tilt. So the idea is we don't want to give up all of our gains in fear. If your objective is obviously capital preservation, then certainly this could go to 100% and you could remove all of your macro long-term core tilts. Again, it just depends upon what type of growth tilt you're trying to apply when you're in this type of market environment where we've got this 2-year trying to converge on the 10 and both heading into the down cycle. So it just depends upon the level of risk and appetite for growth. So when we're looking at the recovery stage, right, coming out of a recession or a black swan event, we really want to take down some of that defensive stance. So we bring that from 85 down to 60%. So that's a 20%, 25% decline. So we're going to pull that full 25% and we're going to put it right into the tactical short-term economic cycle tilt. And then we're going to take 5% from the macro long-term tilt. You can see that it goes from 15 to 10. And we're going to put that extra 5 in here for a total of a 30% tactical short-term economic cycle tilt. So why do we do that, right? The idea is we're going to bring down our tech and communication services weight from 15 to 10. And we're going to use that 5% to maybe get into some of those economically sensitive tech names. Those are going to be primarily your semiconductor names. Okay, then you're going to use the additional 25% to get exposure into those energy stocks, financials, and things like that. Those are the stocks that tend to do really, really well coming out of a recession. And we have spoken in multiple webinars about looking at ISM numbers. There's all sorts of leading manufacturing and services index numbers out there you can look at. I like ISM. Very, very easy to read when you're coming out of the recession, seeing the green shoots. Those surveys that are done are just excellent. And you've got literally 3 to 6 months to execute on this. So it's just, you've got plenty of time. When we start getting into that normalized earnings growth phase of an economic cycle, this is when you're looking at the FY1, FY2, FY3 growth rates like we did in the beginning of this webinar. We saw the S&P go from like a 34% in FY1 down to 11% in FY2, 11% in FY3. That is your normalized earnings growth phase. So you've got literally years to potentially execute on that. The idea is that we are going to normalize out those growth rates and go through a full business cycle. And business cycles can last anywhere from a year, 2 years, all the way up to 8 to 10, maybe even more years. So at that rate, we bring back a little bit more of our defensive stance because we never know when we're going to get hit with another black swan event or something like that. We bring our macro long-term tilt back up to 15%, and we cut our short-term economic cycle tilt down to about 15%. And we just do that to be a little bit more defensively postured. And that's really a good example of 3 different sample allocations, but there's literally thousands of other combinations of this that we could go through depending upon your circumstance. So more than happy to discuss this with anyone. Wanted to spend just a few minutes here on the sector allocation. This is the ECP Dividend Aristocrat Core 25 with no tilts. I'm not showing any tilts because I want to make everything relative to the S&P 500 Dividend Aristocrat portfolio in core. So core to core, it's just going to be a lot more beneficial to look at the charts this way because there are so many different combinations of tilt strategies when you're looking at this particular strategy. So we're just going to keep it all apples to apples. So again, using that 100% weight for a direct replacement to the S&P 500, we do this because the technology and communication services sectors are already equal to or greater than the S&P 500. You can see that here, right? There's no communication services stocks in either the ECP Core Dividend 25 stock portfolio or the S&P 500 Dividend Aristocrats. You can see they're both 0. And you can see that we actually have a higher infotech weight already in core with the ECP Dividend portfolio versus the S&P Dividend Aristocrats. So there's no reason to do a comparison right now with any sort of tilts when we're already overweighted in infotech. Okay. So the idea here is that now is where we would want to apply either short-term or long-term tilts for additional growth and income. And again, if we're looking for just growth, we may want to ratchet up those long-term tilts to get exposure into both communication services, infotech. Remember that we've got Amazon in there as well. That'll actually raise up our consumer discretionary exposure a little bit as well. Keep in mind that the bulk of our tilts are going to come out of the core strategy. So as you're doing this, it helps to have a tool like the Advisor Tools Portfolio Report Builder to run your portfolios through to monitor what's going on with your sector weighting. So you can see in core, again, we're not holding any energy names. You can see that's basically an underweight there. We're underweight materials. We're underweight industrials. We don't own any financials. We don't hold any utilities. We don't hold any real estate. So that's basically what you are using those tilts for, is to get exposure into those sectors and industries. Again, the primary driver, growth and income. Okay. Earning certain family of portfolios, how to become a client. Zacks Advisor Tools, obviously the easiest way to do that. ZAT standard all the way through to Portfolio Manager. If you like all of the Zacks research system charting, including the composites and all the analytic work that you see me do in my webinars, that's the ZAT Portfolio Manager proposition, where you also get access to the Zacks research system. Again, I mentioned that ECP premium support is available for an additional fee. This is really for anyone that wants to use the ECP strategies as their own methodology, and you want that premium level of service for any sort of discussions one-on-one with me or my team, as well as any specific questions on holdings, ECP implementation. We can do style analysis with you, whatever you want, marketing materials if you need assistance with tilts or anything like that. So it is available for additional fee, and I do encourage anyone that has questions to go ahead and just inquire with us. So be sure to join me next week. We are going to continue with ECP tilting strategies, and this is going to be the 5th and final webinar in the ECP series. Then we'll get back to our traditional weekly strategy sessions. And we'll look at what makes tilting around any core portfolio so successful. So we're gonna take that not only to the ECP level, but these are going to be strategies that you can use with literally any core portfolio that you want. So that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you just want a copy of my slide deck, and it could be for this particular webinar, it could be for any webinar, I have them all, just give us an email, give me a call, reach out to us. If you're looking to upgrade your current subscription, you can also contact our world-class support for anything at advisortools@zacks.com. You can also reach us at zrs@zacks.com. Thank you for watching, and I'll talk to you all next week.